All right, okay, good afternoon, everyone. Okay, good. Okay, good. Quick check. Just to make sure, double confirm again, everything is working. If you can see the screen, as well as the audio is working fine on your side, just help me to very quickly type a one in the chat, okay, so that I know, just to double confirm everything is working. Then we'll get started for today's session over here. All right, good. So thanks, Jiajin, and as well as Pang and Nasro. Okay, good. So we'll get started. Today's session here will be focusing on sharing with you the framework that I use, to actually be consistent in algo trading, right? And I strongly believe that moving forward, algo trading is definitely going to be something that gain popularity, and of course, eventually will as traders, right, will have the algo to at least help us in our trading approaches and things like that. Now, I personally believe that there's no way the algo is going to replace the traders entirely, at least not in the next, I would say, like 5 years or so. There are still the strengths of being a trader. Okay, but definitely with technologies, algo trading is definitely going to be able to assist us and make our trading a little bit more efficient. Okay, so as we slowly transit into the popularity of algo trading, I thought it's also important to at least share with you from my perspective, what are some of the factors that you need to be aware of, what are some of the factors that you need to take note in order for you to see some success, as you transit into starting using a little bit more about algo. Okay, so very quickly before we get started, just some housekeeping. Okay, today if you have yet to log in to your MQ account, make sure you do that. Okay, so how you can do it, since you're on this web page, what you can do is you can actually locate on the top right. You can click on the login if you're not there yet. Make sure you log in so that you can actually collect your participation points. And of course, as you ask questions, as you chat, we'll be able to see your name. Okay, so we can address you directly as well. Okay, and of course, if you log in and you participate in this session, in this webinar, you'll be able to get 300 MQ points, okay, as a check-in reward. So basically, here are the steps that you need to do in order for you to actually get that points. Of course, first, open a trading account with the selected advertiser. Sorry. Okay, you need to take a screenshot of this webinar. Okay, so as we go through, any of those slides, you want to take note of anyway, just take a screenshot of it. Then you upload the screenshot through the post webinar quiz, and once you complete that, you'll be able to get 300 MQ points. Okay, so there's also a QR code on the right hand side of the screen right now. Okay, so you can scan this QR code, register to get updates right after this webinar as well. Okay, now there'll also be mysterious gift, as usual. Every session at the end of it, there will be some mysterious gift, and all you have to do is pay attention throughout the webinar, and we'll have 3 questions that we have related to this webinar, and of course the fastest person as well as the correct answer will be the winner of the mysterious gift, right? And there will be in total 6, right? Each question there will be 2 winners, so make sure you be attentive, you pay attention, so that when I post out the questions, you'll be able to very, very quickly know the answer and quickly type into the chat. Okay. Now, before we jump in, last part here is to share with you about VC Plus, right? If you guys are fairly still new to VC Plus, make sure you check out the website www.vc-plus.com. What you can do, you can also register for your free account, okay, via VC Plus. Go and explore the platform itself. There's even the options demo a little bit. And once you do that, right, and you're gaining that confidence, you're comfortable with the platform, then that's where you can actually start to make a deposit, right? Verify your account and of course make a deposit and start trading with VC Plus. Okay. There are also the recent launch of the VC course, right? So again, this is only valid until the end of this year, so you definitely do not want to miss out on that, right? So there are various tier on this offer over here. You can see on the screen, right? You can get 100% discount, 30% discount as well, 10% discount. So again, if you would like to find out more, there is this little QR code that you can see in the middle bottom part of the screen over here. Just scan that QR code to find out more information about this VC course exclusive offer. Okay, so take note, this is only valid until 2023, which you basically have about 1.5 months, right? Or slightly less than that. So if you're keen on this, make sure you take action and actually find out more about the offer. All right. So with that said, there are also some, deposit offers, trading contest offers over here. Okay, so what you see over here is basically running a contest running between now, which is already started, all the way until okay, there's a slight typo. What you see over here is 2023, but it's actually next year, right? So it started in November, which is this month, all the way until Feb next year. Okay, and some prizes to be won include the 9th gen iPad over here for the first prize. Second prize is the Apple Watch, and third is the Huawei phone. Okay, so same thing. If you'd like to find out a little more about this, you would like to participate in this contest, scan this QR code over here on the right. All right, so very simple. Again, opening an account, it's free. Verify your account, make a deposit, and then start trading and participate in this contest. Right. Again, if you'd like to find out more, this is the QR code to scan. All right. Good. Last but not least, this is basically just to keep yourself updated, right? Again, these are all free information. If you like to scan the QR code, join, right, the channel, and you'll be getting updates from it. All right. So very quickly, just leave this here for a couple of seconds so that for those of you who like to scan this QR code, you can quickly do so. Okay, yeah. Good. Okay, so those are the quick housekeeping. Okay, and of course, quick disclaimer as well. Everything that I'm going to share with you in today's session are purely for educational purposes. They are not direct financial or trading advisory. Okay, so just be aware of it. Trading and investing involve risk. If you need any form of advice or I would say guidance, make sure you check with your professional advisory, right? So today's sharing is purely educational purposes, as purely coming from my personal experience, sharing with you what I've went through, what are some of the lessons I learned, what are some of the things that I feel is very, very important for all traders. Okay, and hopefully you're gonna inspire and help you in your trading as well. Okay, so the objectives for today over here, there are a couple of things we'd like to cover. First, of course, is to ensure that at the end of today's session, you're going to have a better understanding about what algo trading is. What is the exact framework to ensure you're going to be successful in algo trading, to ensure that you're going to be consistent and sustainable in algo trading. Okay, what are some important factors to take note, how to manage risk, as well as if today you'd like to get started, what are some of the, I would say, suggestions, right? What are some of the aspects that I feel you need to at least take note or establish first before you get started. Okay, so that's what we're going to cover today. Now, of course, if today I'm going to just share with you about theory and concepts, anyone can talk about it, right? But over here, I want to share with you my journey related to algo trading, which I started back in June 2021, right? So you can see some of the results over here on my FX book. Now, algo trading, or trade automation is not something new. Okay, to be honest, when I got started back in 2012, I mean, in terms of my trading back in 2012, the whole idea about somewhat of a trade automation has already been there, right? But of course, with the recent years, not only in the financial market, but generally across a lot of different industry, the term about AI, artificial intelligence, got popularized, right? And of course, there are also applications in the financial market, right? And that's where the rise of algo trading, trade automation, or even you might hear terms like AI trading, is gonna get more and more popular. Okay, so for me, I got into this trade automation perspective, obviously not in June 2021 directly, but earlier than that. Okay, I've been studying, researching, exploring, trying it myself. But June 2021 is where I decided to say, okay, why not let's take this very seriously, and then put a proper account into practice, right, into a real practical aspect in the financial market, right? And that's where the account started, right? And that's where I would say my real journey into algo trading really got started back in June 2021. Okay. And since then, this particular account has been running 100% fully automated since then. Okay, obviously, I still open and take a look to ensure everything is okay. I top up my funds to increase the entire capital, to let it continue to grow. But other than that, the entire analytical process of identifying trade, the execution of trade, the management of trade, is all 100% automated since June 2021. Okay, and of course, if you take a look at the screen right now, there are some very, very positive months. I would say there are 2 down months, right, in October and November. And even this year here, pretty solid, right? Since the start of this year until November, pretty much every month is profitable. Okay. So I want you to I want to share with you, in today's context, really based on what I've experienced from a practical aspect of using it. Okay. And I hope that if today you want to get started to explore more about algo trading, about trade automation, then at least the framework I'm going to cover with you is able to help you achieve some success, right? Um, so with that said, let me very quickly show you an overview of the framework first, right? And this framework over here that we're talking about is basically this 3 component. Number 1, capital. Number 2, sizing. And number 3, stacking. Okay. And of course, I'll dive into details about this 3 component. Okay. But I feel that if today you would like to trade, I would say you like to use algo to assist you in your trading, whether is it semi-automated or 100% automated. These are the 3 things you probably need to take note of. Okay, capital, sizing, and stacking. Now, how did I came up with this framework, right? And what's the kind of like experience behind actually identify these 3 very important factors that contribute to the success of it? Okay, it's really the intention of wanting to use algo. Okay, why is that the case? Because of course, if today you are able to automate your trading, there are some benefits to it. Okay, so the first one obviously is automation, right? Which means that if you are using semi automation, semi algo, right, at least it helps you to cut down on some work. Okay, so it helps your entire trading process to be more efficient. Now, if you're gonna make it 100% automation, okay, 100% algo to trade for you, then that's even better, right? Which means that literally you don't need to put in much effort, right? Of course, the initial work to design it, to craft this strategy out, takes effort. But once that's done, once that's set in place, then you realize that, since June 2021 until today, that particular account that I'm using, I don't need to do much, right? I just need to from time to time monitor, is everything still working, and then I just add capital to it to let the account grow. That's about it, right? So it becomes something that I would say the strongest benefit is really about automation. Okay. And the beauty of that, it allows the entire algo, the entire system, to actually seek out trades opportunity 24 hours, 5 days a week, right? Of course, sometimes we are sleeping, sometimes we are busy, sometimes we are traveling. We may miss out on trades if we are doing it on manual perspective. But with algo, with automation, it's forever, right? As long as the market is open, as long as your internet is connected and things like that, it will automatically search trade and trade for you. Right? And With that, it also reduces human mistakes, right? What I mean by human mistakes, it's actually from the emotional aspect. It also comes from the technical aspect, right? So emotional aspects of human mistakes are like, you may be affected based on greed, you may be affected based on fear. If the previous trade was a winning one, the next trade you might have the thought process of, okay, maybe we want to increase risk and things like that. And then if you have a losing trade, you may be fearful, and then you may reduce your risk. And that's kind of emotional aspect that might impact your trading. Okay, then the technical mistakes are like, very simple things like, if today you want to enter at a particular price point, and then sometimes you might key in the wrong things, and then you enter at the wrong price and things like that, right? So automation again reduces all this, right? Because as long as your algo is done properly, okay, there's no mistakes in the algo itself, then it will just follow exactly the rules that you put in place. Okay, and as I mentioned, automation, the whole idea here is really about profiting from trading without actually doing the work itself. Okay, and that's really the benefit of it. Okay, but there are also some common hiccups or common struggles that traders face, right? And this includes, losing with one system, and then what they do is they hop around, right? So you try out one system, maybe 2-3 months later it did not work out for you, you change to another system, 2-3 months later it doesn't work out again, and then you keep changing. Okay, or what most traders will also experience is, oh, they make money at the start, right? And then they start to get greedy, they did not have the discipline to control, they increase their risk because they think that, well, if you can make money, why not make more? Okay, and then at the end of the day, they may end up losing the entire account. Okay, so this is very, very common, like kind of, I would say, mistakes or challenges that traders face when they're using algo. Okay, because um, again, if you're very, very new to trading and you don't have some basic foundations about trading, then these are some of the common mistakes you're gonna face. Okay, if you don't understand the framework that contribute to the success of trading system in terms of algo, if you don't have you don't have a good understanding about, how to make something consistent. Okay, then obviously these are the struggles that you'll be facing again and again and again, right? It's kind of like a vicious cycle. Right, so the reason that most traders struggle when they approaches algo trading is really because of this three component. And again, these are the three components that it's coming from my own experience, and eventually I put them into a framework. Okay, so the main reason is, number one, if you don't have a clear main objective of you using algo trading, you're gonna struggle. Okay, so over here I put, right, today you want to ask yourself, is your objective of using algo trading mainly to make fast return, fast profit, or your main objective is to have a sustainable capital growth, right? Which means that you're not primarily looking at fast profits, huge profits in a very short period of time, but you're looking more of like, how can I build something in such a way that I build it once, I build it well, and then I'll just let it run for as long as possible, and that's what I meant by sustainable. Okay, so obviously my goal here is, when I use algo trading, is not to gain fast profit. Okay, because I understand that if today we want to go for fast profit, naturally we need to have higher risk, and with that, it may not be sustainable. It might not be consistent, right? It might be, 1 or 2 months you make a lot of money, but then the third month you may lose the entire thing, right? So my main goal when I approach algo trading is really to make it sustainable, so that, as I mentioned, you do the work once, you do it well, and then you just let it run automated for as long as possible. Okay. Then you need to understand your trading style as well, right? And I always say this, whether it's an algo or whether it's a manual trade, you need to fit a system to your personality. Okay. If today you're conservative, then matching a very aggressive strategy or system, you're gonna struggle with it. Okay. So you need to match that, right? And most of the time, I would say general traders are falling somewhere between in the balance zone. Okay, obviously we want low risk, we want high return, but that doesn't really come, right? You need to be in the balance zone, right? You need to always balance, between risk and reward. Okay, and last but not least, you need to understand your risk tolerance, right? And a lot of times, the thing about algo trading it carries risk as well, right? It's not foolproof. It's not a guaranteed sure win thing. There's no such thing in trading. So you need to kind of look at it from a entire portfolio perspective, okay, and ask yourself this question, right? If they're gonna put in some capital into algo trading system, uh, how much are you willing and how much can you afford to lose in this algo trading system? Okay, and I always suggest that you do not want to put your entire trading capital into one algo system, right? For example, if today you have 100,000 that you prepare to trade, don't put the entire $100,000 in one algo system, right? Because if the algo suddenly doesn't work, and touch wood, you suffer a major loss and things like that, you do not want to lose your entire trading capital. Okay, so from a risk management perspective, you want to always allocate, in portfolio perspective, a certain percentage into algo, okay, a certain percentage maybe into your manual trading, maybe a certain percentage into different form of investment and such, right? So risk tolerance understanding is also very, very important as you approach algo trading. Now, all these are very, very crucial when, or I would say before you even get started in a particular algo system, okay? Because these are like laying the foundations to find out, okay, what is your style, what's your objective, what's your total risk tolerance, and then you design a algo trading system based on that. Okay, not the other way around, right? Not to go and seek out for algo trading system and then start to see, hey, this one I like, this one I don't like, or whatever it is, right? Or find the highest profitable one. You don't search for algo trading system if you haven't established your own requirement. Okay, so this three questions is really the guiding questions that create the framework itself. Okay, and that brings us to, again, capital, sizing, and stacking. Okay, so capital in general is just basically how much capital do you have, right? If today you have a very, very huge capital, great, you have a lot of flexibility in designing things, right? But if today you have a limited capital, then obviously there are limited options that you can do. Okay, we'll dive a little bit into that as well. Then, of course, we have sizing, right? Because things are going to be automated using algo trading. You need to calculate, okay, your sizing properly. And last but not least, how aggressive is your trade management, right? And I put that under the component of stacking. Okay, because whenever we use algo trading, most of the time we're not just going to do one in, one out, right? We're going to use a little bit of what we call a martingale system to manage the trade itself. Simply because we want to mitigate the downside of algo trading. Okay, because in today's context, a lot of, I would say, criterias and conditions that we're going to use for algo trading are purely based on technical analysis. Okay, and we know as traders, technical analysis is not the entire thing, right? Because sometimes there will be sudden news, sometimes there will be fundamental that can contribute and move the market. Okay, and how we mitigate the downside of just purely technical analysis is by using a trade management system to overcome that. Okay, so I'll share with you all this as well as we progress in today's session. Okay, so first, I want you to understand the term martingale trade management, or at least have a better understanding about it, right? Because a lot of times, if you come across the term martingale before, the natural thought process is, oh, it's very risky, you should never use it. Not true. Okay, the trading account that I share with you that I got started in June 2021, okay, fully automated, is using a martingale system, right? So again, I want to use real examples, real accounts to prove to you that it's actually doable. Okay, as long as you understand the mechanics of the management system and you manage it well. Okay, so what exactly is martingale risk management system, right? Is the whole idea about how can we find out profitable ways to resolve trades that go against us. Okay, so I would say, just like I mentioned, right? Most algo trading system are based on technical analysis, and for that reason, okay, a lot of times we're going to use a martingale management system to overcome that downside. Okay, so what I mean by that is because technical analysis, sometimes we won't be able to get in and out of the market at the best price possible. Okay, sometimes based on technical analysis and indicators, we may get involved in the trade, and then the fundamental kicks in, there's a news kicks in, and the trade may go against us. Okay, and then therefore we did not enter at the best time or the best price possible. So what we can then do is we can use a martingale system to overcome that and say, okay, if you did not get in at the best price possible, can we still resolve that first trade, and then end up being a net profitable outcome? Okay, and that's the whole idea about using the martingale system. Okay, so martingale itself is a management technique where, as I mentioned briefly, if things goes against us, okay, we're basically looking to add on to an initial position in the objective of resolving the entire trade with profit. Okay, so there are actually details on how we can actually craft a martingale management system, right? A lot of times people will think, oh, it's just doubling down, but it's more than that, right? Because you did not, number one, you need not double down. You need not always like, times 2, times 4, times 8, times 16. You can actually have a different factor of multiplier. How aggressive you're going to add your position, that's another thing that you want to factor in, right? So it's not so, it's not so straightforward, right? Where it's just a double down system. Hey, there are really details that you can go into to kind of tweak it to make it such that it's a little bit safer. And then, of course, it's more sustainable. All right. So I just give you a very simple example of martingale first. For those of you who perhaps have not really experienced it before, or have not really tried out before, I'll just give you a very, very simple example. Okay. And today you buy a 0.01 lot, okay, at a particular price point of 1.11. And let's say if the price did not go up, but it went down to 1.1, and then of course this particular position you'll be losing $10, right? And if today we're gonna use a martingale system, we're gonna not cut that trade, right? We'll leave that trade there, but what we're gonna do is we're gonna buy again. Okay, so this example I'm giving you is a very simple multiplier of times 2, right? So we bought it at 0.01. The second position we're gonna get in at 0.02. Okay, now suppose if you get in and the price did indeed bounce back up, right, and it went to 1.1033, then this second position will make us a profit of $6.60, and the first position will be losing $6.60. Now at that particular point in time, we can actually decide and say, oh, let's close all the trades and we'll have a break even. Okay, so you realize that if we cut the loss of first position, then of course we'll realize that $10. Okay, and that means that if you want to make it back, you need to win back $10. But with a martingale system, it allows us to have a design in such a way that, oh, I don't need to make back $10, right? I need to just have a system where I can enter a bigger position, and if I win back a little bit, like in this case here, I just need to win back $6.60. I can actually close the entire thing with break even, right? Instead of like having to make back $10. Right? So that's the benefit of it, right? The idea of it is timing may not need to be so precise, right? We can enter at not the best price, okay? We can enter and the market can go against us, but using a martingale system, we can potentially still resolve and end up with profit, okay? And that's actually to mitigate, as I mentioned, the downside of technical analysis, because technical analysis here, based on a fully automated system, the timing naturally won't be the best optimum time to enter, right? Because of multiple factors that can impact the market itself. Okay, so that's where we use this system to actually mitigate that. Okay, so you then need to understand, right? When you use this management system of martingale, not every market can be applicable. Okay, why? Because with how this system works, okay, we cannot use this management system in a market where the general trend direction is gonna be very clear over time, right? What I mean by that is, think of, over here, I put it, right? Think of it as markets such as stock indices, such as commodities like gold, such as crypto market. Okay, what's the overall direction of these markets, right? They're always gonna go up, okay, over time, right? If you take a look at stock index 10 years ago, it's definitely lower than where we is today. If you look at crypto, need not talk about it, right? 10 years ago, the price are lower. If you talk about gold, same thing. 10 years ago, price are lower. Okay. So you do not want to use a martingale system where the market generally trends over time, because if you pick a wrong direction at a wrong time, it's very, very difficult for you to recover if the market trends. Okay. So which is the best market to actually utilize martingale, or say the most appropriate, would naturally be the currency market. Okay, why? Because if you actually take a look at the currency market and you stretch it long enough, again, like 5 years ago, 10 years ago, you start to realize that overall the currency market actually range. Okay, now it might trends a little bit, but overall, most of the pair, they range. Okay, and that's how the currency market works up to today. Okay, so when we want to deploy the martingale system, just be aware, okay, it might not be very effective in certain market conditions, right? And to me, the best market to actually apply martingale is the FX market, is the currency market. Okay, so let's come into this framework and share with you how I personally utilize this framework to manage my algo and design my algo. Okay, let's start with capital. Okay, now my initial capital when I got started back in June 2021, I started with just $700. Okay, but I would say that today, if you start with anything less than 1,000, it's definitely more aggressive and consider a higher risk of getting margin call, right? Because if your capital is small, you don't have a lot of room in which the martingale system can actually kicks in, right? Because you don't have a lot of depth in your capital to manage it. Okay, so I would say if today you have anything less than $500, you probably do not want to get started first. Okay, you want to find ways to build up your capital base to reach somewhere around 1,000 before you really get started. Okay, I got started with $700. It's okay, but just understand that you run a higher risk. Okay, and there's one misconception, right? People always think that, oh, the bigger the capital, the more risky it is. Not true in algo trading. Okay, especially with martingale. Let me point that out why. Okay, because if today, right, imagine your objective in using algo trading is to, let's say, just simply make $1,000 profit each month on average. Okay, now if today you have a capital of 1,000 and you want to aim for $1,000 profit, is super difficult. It's high risk, right? Why? Because you need to basically double your account to make $1,000 profit. But if today your account is 10,000, then what you need, you only need 10% of your capital to actually make that $1,000 profit. Now, if today your capital is 100,000, it's so easy, right? Because if today you have 100,000 capital and you want to make 1,000, it's just 1%. It's easy, it's doable, it's so doable. Okay, so do you need to take very high risks if today you just want to make 1% of your account profit? You don't need, right? And that means that the higher the capital you have, especially in algo trading, right? The easier it is, the safer it is, because you don't need to take very high risks, right? You have a lot of margin available that you can actually support, okay, all the trades that you're running. Okay, so I want you to have this perspective, right? Especially when you want to approach and get started in algo trading, the bigger your capital, the safer it's going to be. Now, the risk obviously is still there. And of course, today, if you have a very big capital, the risk also comes from the platform risk, right? We call it a systematic risk, which means it doesn't deal with the market, but it's really how secure, how safe the platform is, right? So there's still risks. You still need to, of course, do your homework and study it. Okay, but in terms of trading perspective, from an algo perspective, the bigger your capital, the safer the trading is going to be. Okay, and the hint over here is the risk is not how big or small your capital is, right? The bigger it is, of course, the more room you can design in terms of risk. But the real risk comes from how you control your sizing and stacking, which is the two other component. Okay, not so much on the capital, right? And my take here is the bigger your capital, the safer it is. Okay, so smaller capital, the psychology over here is also important, right? If today you start with $1,000, you may be willing to take a higher risk, right? You may say that, oh, if I lose $1,000, I lose the entire account. It's fine, right? It's not the end of the world. But if today you have a bigger capital, like you have a $10,000 capital, you have a $100,000 capital, the psychological approach towards it is very different. Okay, and this is something you need to take note of as well, right? If let's say today you're very, very new to a particular algo, okay, you might want to test it with a smaller account, okay, just to fine tune it, and then as you gain confidence in it, you better understand the mechanics of it. Okay, then of course you can start to increase your capital base. Okay, so as I mentioned, just now I started my algo with $500 to $700, right? And over time, that's where I start to build up the capital base for my algo to continue to trade. Okay, so that's on capital. Okay, then we have the position size, right? So position size is also very important, right? Because it's going to directly relate to your risk. Okay, so as a reference, right? I will always suggest traders to start small. Okay, even if today you have a huge capital, let's say today you start with $10,000, my take is also start with the smaller size. Why? Because you need to gain that confidence, you need to gain that clarity, you need to understand the entire mechanics in the total, right? So of course, if today you start with $1,000, then never go beyond 0.01. Okay, start with the smallest lot size. Okay, always start with the smallest size. Okay, and that's quite straightforward, right? Basically, that's your sizing. Okay, of course, as your capital grow, your sizing needs to be adjusted as well. But as I mentioned, okay, the bigger a capital is, the less risk you can actually take, because in order for you to achieve your profit objective, it's easier with a bigger capital and you don't need to take higher risks. Okay, so with that, let's talk a little bit about stacking. Okay, so your sizing is basically how big, how small you design your algo to start training. Okay, now stacking is where the real work comes, right? Because stacking here is where we need to talk about two things. Okay, one is the multiply effect, right? And second is basically the stacking in terms of like adding of layering, right? I call it layering. Is basically how far before you add your second layer, how far before you add your your third layer. Okay, and every time you add a layer, what's the multiplier factor? Okay, so there are these two things that you need to consider, right? And for us to design the system of martingale management based on these two things, which is your stacking and your multiplier, you need to then also factor in what's the average movement and the average volatility of a particular instrument. Okay, because if today you are trading, putting algo trading into euro dollar pair versus you're putting it on, let's say, pound New Zealand. Okay, it's a very, very different volatility instrument, right? One is less volatile, one is more volatile. Your design of the multiplier factor and your stacking needs to be different, right? You need to factor that in. Okay, so stacking is basically a component that you tweak and design to see how aggressive your entire trade management system is going to be. Okay, the higher multiplier factor, of course, the higher risk it's going to be, right? The nearer your stacking is, which means price move a little bit, you add another layer, move a little bit, you add another layer. The more aggressive you are, the more risky it is. Okay, and what you want to do is find a good balance, right? Again, as I mentioned, you need to be very clear what's your objective when you're using algo. Are you gunning for that burst of quick profits, okay, or are you going for the sustainable aspect? Are you more conservative? Are you more aggressive, right? You need to be very clear of your style before you actually design all this component. Okay, so a higher multiplier factor has its benefit as well, right? What I mean by that is, for the first trade, let's say you go in with one lot. Okay, your second position, when you add in, are you going to do a simple multiplier factor of 2, 3, 4, or less than 2? Okay, so a 2 multiplier factor basically means that from one lot you times 2. Okay, then the third position is 2 lot times 2 again, so it becomes 1, 2, 4, 8, 16, 32. Okay, you can of course be even more aggressive. You can say, I don't want to times 2, I want times 3, right? So from 0.01 or 1 lot, the next position you're going to take is 3 lot. Then from 3 lot, you're going to take 9 lots, right? You can design according to what your risk tolerance is, right? Of course, the higher multiplier effect, the easier it is to actually recover trades. Why? Because you're entering a bigger position, right? But at the same time, it's also riskier, right? Because if your second position don't go against you, you enter a third one, which is way bigger, you need to use more margin. And if let's say the third position doesn't go, doesn't go in your favor, it go against you again, then you need to consider a 4, 5, and 6, right? So you need to consider all those things, okay, as you're designing your stacking component, okay? So it's always, again, a balance, right? Your role here is to understand as much as possible in the mechanics of a market, okay? Understanding your style, what's the objective you're going to hit, and then try to find that balance between, okay? Then we have the layering, right? So what I mean by layering is how far would the trade needs to go against you before you add another one, okay? So if today you say, oh, every 20 pips, if the market go against me, I'm going to add another layer, okay? So every 20 pips, you add one layer. Every 20 pips, you add one layer. Then it becomes very aggressive, right? Because 20 pips in a FX market is fairly easy to hit, okay? So the more aggressive your layering is, again, the easier it is to resolve trade. It's easier to actually make money, but it also means that you're going to take a lot more trades, and you need to factor in, is your capital enough, right? Is your margin sufficient? Are you able to sustain that kind of layering? Okay, so there are different components definitely you want to factor in based on which currency pair you're trading, right? Are you trading a very volatile pair? Are you trading a less volatile pair? How much capital do you have to sustain the aggression of your stacking component? Okay, so I'm going to share with you what I have. Okay, it may not be the answer to all your algo trade system, okay, but this is based on what I have been using since June 2021. Okay, so I basically have two algo that trades different currency pair. Okay, and my suggestion again is try to only use one, or I would say try to focus on one currency on one algo system. Why? Okay, because if today you have one algo system and you try to trade multiple currencies in that one portfolio, it can get very confusing, right? So what I would suggest is be focused, have one algo trade one currency, or one account trade one currency. Okay, so what I have over here is I have the euro dollar as well as the dollar Canadian. Okay, and my setting over here is I'm using a range of 50 to 80 pips for my layering, right? What I mean again is that the price needs to go against me somewhere between 50 to 80 pips before the algo is going to seek out for another trade to add on to it. Okay, and if today I'm looking at euro dollar, I'm using a multiplier of 2x. But if I'm using the dollar CAD algo, I'm using a 1.7x. Okay, so a 2x basically is quite straightforward. As I mentioned, 0.01 lot, the next layer 0.02, the next layer 0.04, the next layer 0.08, and etc. etc. Right? 1.7 is basically if today I take one lot, the next position is basically 1.7 lot, and then times 1.7 times 1.7 times 1.7. So it's actually less aggressive. Okay. So again, this is something that you need to factor in, right? The aggression of things. Okay. So how do I design my layering? Okay. I basically reference to just like I mentioned, right? Volatility of a particular pair. So because I'm looking at euro dollar, I'm looking at Canadian. What I did was I go and study, okay, in the past, what's the average daily movement, so that I can consider, right, if today the market really go against me, how many positions I'm going to add on using this algo. Okay, so I look into the average daily range. The data over here on the screen, you can see is all the way from 2014 all the way until last year data, right? Now, if you focus on euro dollar, it's actually on average, you're roughly going to calculate somewhere between, I would say, 80 to 90. Okay, because you can see some years can be quite low in volatility, some years can be a little bit higher. So I would say average out somewhere around 80. Okay, dollar Canadian is a little bit more volatile, but if you average out, it's still somewhere between maybe less than 100. Okay, so when I design my layering of 50 to 80 pips, right, what it means to me is that in the worst case scenario, if that day is very volatile and the market go against me, at worst, I'm going to add maybe one or two layers. that's about it, right? Because if I enter at this price, it goes against me and the average daily movement is about 80 pips, I'm going to add one layer. Okay, if that day the market move 100 pips against me, at worst, I'm going to add 2 layers. Okay, so in a way, it's manageable, right? Because I know that, oh, it wouldn't suddenly, 10 trades comes out, right? I know that worst case scenario, 2 or 3, right? Very, very seldom I'm going to see like 3 layers within the day. Okay, so what this means again is I can then factor in, all right, if today the market really moves like maybe 500 pips against me, okay, and then on average 50 pips per layer, so I'm probably gonna get like 10 layers. Seldom the market move 500 pips without any kind of like a retracement. Okay, 500 pips straight up, very, very seldom. Of course, I can't say it won't happen, but those are very rare occurrence. Okay, so if today I'm gonna design a martingale system, I'm gonna design my entire algo, right? I need to really design all this even before we get started. Okay, it's by factoring, okay, if today I'm going to have 500 pips move, I'm going to have 10 layers of stack. Based on my sizing, based on my multiplier effect, would whatever capital I have able to sustain that kind of drawdown? Okay, because at the end of the day, when I'm using martingale, what am I trying to achieve is, at the end of the day, I want the market to reverse or retrace so that I can resolve the entire trade. Okay, and it's always a discussion about how aggressive it is versus how much capital you can to sustain that. Okay, so as you design all those things, these are all the factors that you need to consider. Okay, so kind of hopefully give you some idea onto it, right? So if today you are designing a very aggressive stacking, right, and you basically allow yourself to maybe only have 3 or 4 layers to sustain, then it's very risky, right? Because 3 or 4 layers again is pretty easy to hit. Okay, because if the market moves 200 pips, 300 pips against you, probably you're gonna hit that 3-4 layers, right, fairly quickly. So always give yourself a sufficient buffer. Okay, and let's say, okay, I need my martingale management system. I need my algo to be able to sustain like 10 stacks. Okay, 10 layers. So based on this 10 layers, what's my multiplier? What's my capital? If it hits 10 layers, based on all the lot size, based on all the potential drawdown, can my capital still handle it? Okay, so those are things that you probably need to design in. All right, so hopefully that gives you a better understanding of things. Okay, yeah. Now, before I go into questions, just very quickly, last slide over here on some of the tips to get started. Okay, so first thing first, right? A lot of times people think that, oh, you need to be able to learn how to code. Not necessarily. I mean, in today's advancement of technology, there will be some algo that you can even kind of like drag and drop. Okay, that's what we call it. Or if today you really wants to code it out, you can even outsource this coding job, right? But of course, what you need to know is you need to have some basic understanding about what can be coded and what cannot be. Okay, and of course, what I mean that is like if today you say that, oh, if Jerome Powell says something like that, I want the trade to do like that. There's no way that can be coded, right? I mean, in today's technology and a retail tech, right, retail technology perspective, there's no way someone can go and decode, okay, what Jerome Powell mentioned. Okay, so obviously you need to be sensible, right, in terms of like what can be coded, what cannot be coded, right? You need to have some basic knowledge about that. Okay, you obviously need to have some basic knowledge about trading as well. So if today you are like very new into trading, right, very new into the FX market, then my take is equip yourself with that knowledge first, right, before you jump into algo trading. Okay, if I give an analogy, okay, algo trading is actually something like like maybe a sports car. Okay, if today you haven't learned how to drive, you haven't gained enough experience on the road, and then you immediately jump into like a hypercar or supercar, there's a very high chance you're gonna bang onto something, right? Because you can't control that car. Okay, it's actually the same analogy over here, right? If you think of algo trading as a supercar, it can enhance your trading. It can ease a lot of things. It can make things easier for you, optimize things for you. But if today you don't have the basics about understanding the market, then it may do you more harm than benefit. Okay, so always think of it that way. Okay, so again, these are some of the things you need to establish first before we actually go on to algo. Okay, and of course, over here at VC Plus, right? I mean, right now it's not basically launched in the public yet, but this is something that the card told me also that they will be releasing soon. Okay, but it's not going to be available to everyone in the public, right? So this is something that if you are keen, you need to register your interest, right? So what you need to do is there's a little QR code there. Okay, whoops, how come they jump, right? There's a little QR code there, right? So what you do is you scan that code. It will lead you to a Google form, and you basically fill up your information there, right? And once they kind of launch this, you'll be notified. All good? Yeah. Good. So very quickly, I think I will do the quiz first, okay, and then I'll look at the questions. I see some questions coming in. Okay, I'll do the quiz first, then I'll answer the questions. Okay, so the quiz over here is basically 3 questions as I mentioned, right? And if you get it right, the first 2 person who get it right, are gonna win the mysterious gift. Okay, so what you need to do is once you're identified as a winner, you need to actually fill up the Google form. Then MQ Trader over here will be able to send the gifts over to you. Yeah, so get ready. The first question is, what are the 3 factors that we discussed today? Okay, so basically you put in which 3 it is, right, in one sentence, right? So A is capital, B is stacking, C is sizing, D is strategy. Okay, so again, put 3 answers. You know, if you think it's like A, B, and D, then A, B, and D in one line. Okay. Okay. Good. So I see over here from my side, Pang says ABC, YX say ABC. Yeah, basically the answer is ABC. Okay, the 3 factors that are very important in algo trading that we discussed today, the framework, okay, is basically capital, stacking, and sizing. Okay, yeah. So I think the fastest person I see that give an answer is Pang and YX. Okay, so yeah, again, use that Google form, submit your details so that they can send you the gifts. Second question, which market is best utilized for a martingale management system? Again, this one we can't highlight it, right, quite a bit. A, currency, B, stocks, okay, C, crypto market. Okay, so which one? Good. From my side over here, I see is Nasro Hakim is the first answer on A, which is correct, is currency. And the other one is Stephen Lim. Okay. Second answer over here is A, right? So A is currency market. Why? Because for martingale to be utilized, ideally we want a market that generally range over time, right? You don't want the market to be trending strongly over time. Okay, so yeah, congrats to Hakim and Stephen Lim. Okay, last one here before we take a look at Q&A. Okay, what is this true or false, right, in terms of statement? The larger the capital, the larger the risk. True or false? Okay, this one is where we discuss, right, in terms of the capital framework. Okay, in terms of algo trading, is larger capital equivalent to larger risk? Okay, actually the answer is not entirely true, right? Because as I mentioned, capital, the bigger it is, the more flexibility you have in managing your risk setting, right? Actually, the larger the capital, the more flexibility you have, the lower the risk you can go. Okay, so the right answer is actually false, because that is not an equivalent statement. Okay, so congrats to Ayman and Kyoki over here. Okay, so very quickly, I take a look at Q&A. I think I did see some questions coming in. I think since we started. Okay, good. Okay, so I see a question over here from Caterpie asking, are there specific indicators or signals that traders should use in conjunction with the martingale strategy to enhance this decision making? Okay, to be clear, martingale is a management system. Okay, your entry and execution decision is where your strategy comes, right? So this is really broad. Like, are you going to use indicator based? Are you going to use price action based? Are you going to use multiple? Are you going to use a combination of things? That's where you need to decide, like, what strategy do you want to base on? Okay, so you want to see them separately in a way. The strategy to execute the trade is one thing. The martingale itself is the management system, right? So they are basically two components, put them together. Okay. Yeah. So in terms of that question, is there any specific indicators or signals? It really boils back down to what's the strategy you really want to use. Okay. 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 Talia Fox here says, what is the success rate of this strategy? I mean, I can only speak on based on what I have used, right? So I've kind of shown you at the start, this, right? Let me just go out. All right. Yeah. So this is the MyFX book results that I have. Okay. I mean, this one here I screenshotted when I'm preparing slide. It's all the way only on October, right? But of course, right now we're in November over here. Okay. So I can't obviously I can't guarantee that algo trading, the system that I'm using is 100% foolproof, right? But what I can just share with you is based on what this algo has been doing since June 2021 until today, it's pretty sustainable. Okay. Yeah. So in terms of success rate, if you're talking about like how many trades are winning, how many trades are losing, because we're using martingale system, right? It doesn't really matter. Okay, because we look at trades in basket, right? If that trade goes against us, we do a stacking. Okay. And once we stack, and the basket of trades ends up profitable, we close the entire thing. Okay. So from a martingale management perspective, the success rate is not really that important in terms of like, how many trades are winning, how many trades are losing. From a martingale management approach, is not so important, right? But from a normal risk management perspective for individual trades, then yeah, that strategy, you want to have a higher winning success rate, right? So that perspective of success rate is different when we are using martingale and versus we are not using martingale. Okay, so hopefully that can give you a better understanding of what I mean by success rate over here. Okay. Kilogram asks, how do traders determine when to stop using martingale system, especially if they encounter a prolonged losing streak? All right. So that's something you need to also design in, right? Let's say if today you have a hard cut, right? So what I mean by a hard cut is, if today, you say that if things goes very bad and you experience a drawdown of maybe like 50%, right? Then you want to cut everything. Okay. So that's what I mean by hard cut. Okay. But my take here is, since you are already aware that you're going to use a martingale system, okay, what you want to design is not a hard cut, right? That's my take, right? It's not like the model answer, but from my perspective is, if I'm already using a martingale system to manage my trade, I don't want a hard cut. But what I want to do is I want to ensure that, in a very bad situation, my martingale system is designed such that my capital, my margin is still sufficient. I'm not sure if that makes sense. But the whole idea is, if today I'm not comfortable with, let's say, a 50% drawdown, then instead of doing a hard cut, I design my stacking and sizing in a way that even in a very terrible position, I won't end up with a 50% drawdown. Right? Does that make sense? Right? So I'm gonna be like designing my stacking very conservatively, my position sizing very conservatively, so that in a way, even if I get 10 stacks, my drawdown is not 50%. Okay, so if I'm using martingale system to manage my algo trade, right, I'm gonna come from that perspective. Okay, so hopefully that kind of makes sense to you. Okay. Yeah, good. Nasro Hakim asks, is there a reason for different currency pair versus different multiplier? Not specific in like different currency pair, but more in terms of like I'm actually more conservative in the dollar Canadian algo, and I'm more aggressive in the euro dollar, right? So it's not really currency specific, but it's just that when I'm looking at the euro dollar algo, I'm willing to take a little bit higher risk on that, right? A little bit more aggressive. That's why it's a 2x multiplier. And for dollar Canadian, I'm going for a little bit less risky, right? Less aggressive, and therefore I'm doing a 1.7. Okay, so that's the main reason for me. If the market still goes on in the same direction, how can we recover losses like that? Okay, so questions from Carby, right? So that's the part you need to understand that in the FX market, right? So you need to go and study statistically, okay, how far would a currency pair move in a very huge trending environment before it starts to retrace, okay? Because okay, let me just very quickly show you. Right, let's open one chart here and then I'll just show you that. Okay, yeah. So let's just talk about I don't know, just pick one, right? Euro dollar. We'll go on to a, let's say, weekly chart. Okay. So I want you to see, right? Even in a condition where it's trending, look at this. It's trending, right? But every time it comes down, there's a move up, right? There's a move down, there's a move up, there's a move down, there's a move up, there's a move down, there's a move up. Okay. So while even if it's a trending environment, you can see the currency market tends to have up and down. Okay. And if today, okay, imagine you buy it, okay, let's say you buy it here, the market comes down. Okay. So you're gonna stack up, right? And then at this point in time, you're gonna recover everything, you close it, and let's say you buy it again at the worst price possible. You go down, you stack it up, this retracement, you're gonna recover it. Okay. So the study of it is the statistical perspective. Like let's say here, okay, you sell it here, it goes up. Let's say you stack it, you did not manage to close this, it continues to stack, and then at this point is where you may be able to recover it. Okay, so then what you need to factor in, okay, statistically, if this is like huge run, right? So this is almost like 1,000 pips. Okay, in that 1,000 pips movement, okay, how many stack can your account survive? Okay, those are the statistical study that you need to do. Okay, and of course we're in a weekly chart, right? I mean, if today you break this down to a daily, I think internally we have sufficient retracement to actually recover trades. Okay, take a look, right? Even if on the weekly you can see it's huge up, the market moves in waves in the FX world, right? So you look at this, right? If I can't bought it here, I sold it there, it goes against me, I recover it easy, right? If I sold it here, this goes against me, these are chances where I can recover. Even if not, it goes up, I stack it here, this can recover. Okay, so that's something that you need to study a bit, of course, right, in terms of understanding the mechanics of the market as well. Okay, so I hope kind of give you the understanding on from questions from Kilogram here. Okay, sorry, questions from Caribbean. Okay, cool. Okay, so yeah, I think those are the questions that we have. That's all that I see over here. Good. Okay, so I hope today's session here give you a better understanding about what algo trading is. Okay, and again, I'll just flash this very quickly for the QR code. For those of you who would like to, express your interest, okay, make sure you scan that QR code, fill up the form, and once they launch it, you'll be actually notified about it. Okay, so yep, that's all from me. All the best for those of you who wants to kickstart your algo trading. Hopefully, again, as I mentioned, today's session give you some better insights into the approaches, what are some of the factors to consider. The framework, I think, is an important aspect, capital sizing and stacking. Okay, so with that, okay, I'll see you guys in the next webinar itself. Okay, so see you guys. Bye-bye.
Thanks for watching.